In 2020, in absolute terms, we performed reasonably well, but in relative terms, we underperformed against the MSCI World. 2020 was a very interesting year in that obviously it was a year of the pandemic, and in the first quarter we saw markets fall substantially. And during those falls, we performed very strongly and outperformed the market, which is typical for us, and that we look to preserve capital. In the remaining 3 quarters of the year, though, the market rose around 45%, and we underperformed during that rise. And really it was due to 2 reasons. The first was that we are underweight technology. Technology shares in general are quite expensive, and so we don't have much exposure to technology. And secondly, we're overweight in aerospace, where we have what we think are some very high quality companies, but obviously they were particularly COVID affected during 2020. Now, our focus at Veritas is generating strong returns over long 5-year periods. And we think that the aerospace positions we hold in particular will deliver those robust returns over the following 5 years. During 2020, we entered the year with some cash, and during the pandemic-related declines in equity markets, we used the declines to increase a number of positions and introduce some new positions into the portfolio. For example, we bought MasterCard, the card payments business, and we bought Fiserv during those declines. We also took the opportunity later in the year to reduce and sell some positions that had benefited from COVID disproportionately, we felt. So for example, Reckitt Benckiser, which sells bleach and other household products, performed particularly well as people were buying these products simply because of COVID. And so it's a very short-term impact on demand, and we used the rise in the shares to sell those positions. The equity markets during 2020 were extremely surprising in so many ways. If somebody had told me at the start of the year that we would have a global pandemic and we would see huge declines in economic activity and huge declines in earnings, and yet equity markets around the world would be up, that would be a huge surprise, and I would not have predicted this. It seems to us that through monetary and fiscal policy, we've seen policymakers have really engendered a large rise in markets. Obviously in the economic world, interest rates power everything. And so by having such low interest rates, with central bankers around the world buying bonds in order to keep interest rates low, what that's led to has been a massive rise in asset prices and equity valuations. And so it's been a huge surprise to us to see the strength in equity markets on the back of what have been substantial economic and earnings declines. One of the major consequences of these interest rate declines and interest rate suppression is that the best performing companies in that environment are the high growth companies, where the earnings and cash flows are likely to be a long way out in the future. And so we saw, if you look at the MSCI World, that the best performing companies were all high growth companies. In fact, if you look at the top 50 performers in the MSCI World, they delivered performance of around 150% during a total return of 150% during 2020. And their average PE ratio is almost 300 times, despite the fact that 5 of these companies make losses. As long-term investors looking to invest in high-quality companies with durable competitive advantages, we do not select equities based on macroeconomic forecasts, and in many ways think as a long-term investor this is a foolish thing to do. If we'd been told at the start of 2020, for example, that there would be a pandemic, we would see huge declines in economic activity and huge declines in earnings, we would certainly not have predicted that equity markets would rise double digits during 2020. And so I think that goes to show that making predictions based on macroeconomic forecasts is very difficult, even in the short term, but certainly over the long term. And it's not something that we will do. We will continue to try and invest in high quality companies when they're attractively valued. So the first few months of 2021 have seen bond yields rising moderately. Now they're still very suppressed, so we still have around $15 trillion worth of government bonds that are negatively yielding, and that means there's huge mispricing in the fixed interest market. Now, as we've said before, interest rates power everything in the economic world, so as interest rates rise, it will have an effect on overall valuations in the equity market. Now, the companies that will be most negatively affected by a rise in bond yields are those more speculative, very high growth companies that we saw delivering very strong performance in 2020. These companies where the earnings and cash flows are a long way out in the future will be the most negatively impacted, and we're likely to see compression, perhaps even a significant compression in their valuations if bond yields continue to rise. The pickup in inflation that we've started to see and may continue will have no impact on our investment style. We are long-term investors in high-quality companies with strong competitive advantages. And we believe that the companies that we invest in will perform well in an inflationary period, particularly if inflation is in the low to mid-single digit. And we're certainly not envisaging inflation returning to anything like the 1970s. So an increase in inflation expectations won't impact our investment style or philosophy. The companies we own are all high-return companies with very strong cash flows and would perform certainly relatively well, and probably absolutely well in a relatively high inflation period. In general, we're always looking to invest in companies that have strong competitive advantages. However, we do like to invest in companies that have tailwinds, and so they will generally benefit from stronger growth due to those tailwinds. A couple of areas that we particularly like at the moment are companies that benefit from digitization. So that might be Facebook or Alphabet, or that can prosper in a digital world. So again, things like MasterCard, where we're seeing a shift to online payments and purchases. Equally, we like companies that can assist people live a healthier life. And so we have quite a weighting in healthcare. So the companies that we invest in the healthcare field tend to be those companies that can improve people's quality of life, especially when they're aging, so that older cohort and the geriatric age group. And it might be things like hearing loss, where we have investments, or eyesight. And so we think by owning these companies that the beneficiaries, so the patients, will lead a better quality of life as they age. Two of the companies that performed well for us during 2020 were Charter and MasterCard. Charter is a cable company in the United States. Their primary business today is the provision of high-speed internet connections to residential homes. And during 2020, no surprise, there was increased demand for their high-speed internet. They tend to be able to offer higher speeds than their telco counterparts, and they tend to be able to do that at a cheaper price than their telco counterparts. And so they've seen a substantial increase in people wanting their broadband connection through Charter. And at the moment, the company only has around 52% of the households that it's passed connect to Charter. And so there's quite a long runway for growth still within Charter, so we're still very positive on its prospects. The second company is MasterCard. MasterCard we bought during the declines in March 2020, the COVID-related declines. And so we entered the position, what we think, at a very attractive price, around $216 US. Since that point, the company has performed very well. We've seen a substantial shift to e-commerce, which has benefited all the card payment businesses, but MasterCard and Visa in particular. And we think that over the next year or two, we'll see a strong return to cross-border transactions, which are very profitable for MasterCard, as people return to traveling. So we see particularly leisure travel and visiting family and friends returning, and we think that will benefit MasterCard substantially too. BAE is a stock that didn't really perform as we anticipated last year. We bought BAE around 2 to 3 years ago, And at the time, we felt that the company had a lot of clouds on the horizon that would clear positively. So they had a big pension deficit, which is now sorted. They weren't turning their earnings into cash flow in the way that they should, and that again has been sorted. They had Jeremy Corbyn hanging over them and a UK Labour government. And so they had all these issues hanging over them, which we felt would all reconcile themselves positively, and they have. But the share price has not performed at all. So it's flat from where we bought it. The shares are trading on 10 times earnings, around an 8% free cash flow yield, a 5% dividend yield. And we really don't understand why the market is not ascribing a valuation to BAE that we believe is commensurate with the quality of the business. And so it does remain a frustrating holding for us. The shares have not performed as we would anticipate, but we will remain patient because the company, from an operational perspective, is doing everything that we thought that they would. So we believe that over time, the value in BAE will become catalysed. ESG is very important in our stock selection process and is embedded within the process and has been since we started the firm in 2003. When we analyse a company, so as the company moves through that analysis phase, the analysts are continually looking at ESG issues and trying to understand what the most pertinent issues are for each company. Typically we will look from an environmental side at the carbon disclosure, and also we'll be looking to ensure that the company have targets for them to reduce any carbon emissions and check that those targets are sensible and that they have plans in place to reduce their carbon emissions. From a social side, we tend to be looking at things like living wages and minimum wages and ensuring that others within their supply chain offer minimum wages or living wages. And from a governance perspective, we actually think the governance perspective is probably the most important out of ES&G. We think if the governance of a company is good, then the E and the S fall out of that. So it's very important for us that the governance of a company really understands ESG issues and takes them seriously, and we will be appraising the company as it goes through our analysis phase on all of these things. And then if we end up owning a company, we will obviously continue to monitor ES&G issues and engage with the company on those issues. We don't think that you need to sacrifice investment performance in order to maintain your investment principles. Having said that, it's not our aim to be the moral compass of our investors that some people may find abhorrent. So for example, alcohol, we will invest in. And so we're not trying to decide where that line lies. In broad terms, if something is legal and we think it is moralistic and allowable, then we will look to invest in it if we think it's a high quality company with strong competitive advantage. With regard to ESG and specific stocks, in general, if we're not comfortable with an ESG issue on a specific stock, then it won't go through our investment analysis phase. And so we won't end up investing in the company because it hasn't met our ESG requirements to start with. On occasion though, we may invest in a company where it's lacking on one aspect of E, S and G, but we think that we can engage with the company and improve that aspect. And we've done this on a number of occasions. A good example would be Charter, one of our bigger positions, a US cable company that for many years refused to disclose its carbon emissions. And we engaged with the company, as did other investors. And the company this year will start disclosing its carbon emissions from 2021 onwards.